Key inflation readings ahead this week, both CPI and PPI. Oh, God. We get through the jobs report, and then that comes. Joining us to talk about the potential market impact, Cameron Dawson, Chief Investment Officer of NewEdge Wealth. All right, here we are, 41.50, 41.36. Been going up, Cameron. Is it going back down, or are you ready to jump in?
Well, we're in the same place talking about the same things because the market really has gone nowhere for the past couple of months and the last 6 months, the last year, the last 2 years. We're now officially flat. But this market, I think, is going to have challenge getting much above the 4,300 level without a real change in recession probabilities. We're already at the high end of prior valuation ranges. We're trading at 18.7 times 2023 earnings, which is expensive by historical standards. So that puts the onus on earnings to deliver to the upside. And what we're seeing after this earnings season is, yes, companies are coming in better than expected in the first quarter, but analysts aren't raising their estimates for the full year 23 because there's already a big ramp already priced in and a recovery priced into the back half of 23. So we think we're still stuck in this sideways chop without the ability to have escape velocity, really, unless you see recession risks fall materially.
Waiting, though, for this recession. It never repeats itself. We know that. Sometimes it only rhymes. I'm talking about history, but are you sure there's going to be a recession in 2023, Cameron? I can't say with certainty, and I have seen times in the past where we've been waiting for a recession for 1, 2, 3 years. It just doesn't happen when you're just waiting for it to happen. Is it definitely in the cards in the next year?
No, it's not a certainty. And one of the reasons why we saw the economy hold up so much better than expected really in the past 18 months is because loan growth remained so strong. So despite the fact that there was all this terrible sentiment, we all expected a recession, it was reflected in soft data. Hard data remained resilient. Banks kept lending. Consumers continued to spend because they had jobs. And that is the state today. So a recession in the very near term is certainly not guaranteed, but the risk of recession still does remain high simply because of the speed and magnitude of the Fed's tightening cycle. And now, of course, this new risk that we could see bank lending slow rather materially, which is typically consistent with much slower growth and potential for recession. So the risks are still there, but the timing remains still very uncertain.
Got about a minute left, Cameron. When does the market start going up in terms of when a recession? A lot of times people say by the time you're in recession, it's time to buy the market. So maybe we're not in one yet, so maybe it's, in your view, it's not time. But does it coincide? Does the bottom usually coincide with when the first quarter that we have of a recession?
Not necessarily, but I think that there's two things that typically happen around recessions that makes markets have buying opportunities. The first one is that earnings estimates get cut very materially, so the bar gets lowered, and you have a reaction from Fed policy where you see the Fed react to recessionary conditions and start making liquidity much more abundant, cutting interest rates and doing quantitative easing. That typically boosts valuations. And so even though real economic growth and real earnings might still lag in the recession, usually the market bottoms long before those turn higher simply because the Fed is reacting, pumping markets higher with liquidity. So we really haven't gotten to either of those states yet, either the fact that earnings estimates have been cut.